Today we are joined by our friends from Harvey Spack Field, and we're providing a market update into the UK retail park sector.
Thanks, Aaron.
The next 40 minutes, we will be talking through our experiences of having worked directly in the sector over the last 6 months and drawing out some of the evidence, the findings and observations that we have made through working in the sector. Critically, we'll be looking at where we think the sector is heading next. We'll be joined today by Jonathan Salt, Nalin, Nilaweera and Justin Houlihan from Harvey Spack Field, who will be individually presenting their views from their work in the sector. At the end of the session, we'll be having a short question and answer session. So please do submit questions to the webinar, and we'll try and aim to cover as many of those off as possible at the end of the session. Just to recap on Pragma, we are hosting the session today and utilising some of our work that we carry out in the retail park sector, be that commercial intelligence work, commercial strategy, revenue and forecasting, due diligence, and supporting with operating and leasing. And it's through this project work that we've gained our insights that we'll be leveraging today alongside Harvey Spack Field. As an introduction to today's session, we carried out a webinar on retail parks in June of this year, and the summary of that was the strength of the sector and how it had performed during and immediately after lockdown. What we had seen was the benefits that retail park as a format presented during the pandemic, but not only related just to the pandemic from a consumer changing shopping habits and the interrelation of online sales and physical sales, meaning that retail parks were a preferred location of choice for a number of consumers. That was then leading to strong occupier performance and occupier demand, and subsequently stimulating investor interest. And it's that investor interest that we want to touch on and update you about today. So I'll hand over to begin with to Jonathan Salt of Harvey Spack Field to give us an insight into what's changed over the last 6 months.
Thanks, Andrew. Thanks, and succinctly put. I think the general helicopter view is things have remained strong. Following on from our last webinar, we've seen so much activity both in the capital and the lettings markets. Hammerson's boxes and the Railpen portfolios have all completed with their sales, while several other parks and Solus units have changed hands. Simultaneously, what we can see from our agency department is there's been a similar level of activity in the lettings market as retailers and leisure operators seek to push their expansion programs post the lockdown. We've seen new entrants to the market such as Brookfield, US Realty, Hobart, Titan, DS Property, and obviously the existing heavyweights in Threadneedle and M7, who clearly see the investment rationale in the sector. And this is despite many experienced commentators previously calling time on the retail warehouse market. In our opinion, the strong investor appetite is for good reason. However, there must be some cautious optimism. There are several potential pitfalls, short and long-term concerns that need to be addressed, predominantly supply chains, the reintroduction of rates, payments, inflation, and of course, the online onslaught that we are seeing, particularly in the fashion market. Only 12 to 18 months ago, valuations were challenged, and only the well-advised brave investor took the plunge. So, why has sentiment changed so much and so quickly? We're seeing through our own sales that there's a competitive bidding process and a lot of demand to buy these things. There are several drivers for this, which we touched on previously in the earlier webinar, but these have kind of now fattened out and given us some clearer indications. The main substance behind that is obviously the continuous need for investors to deploy capital. Whilst there's expensive, fashionable distribution sheds are still in vogue, in our opinion, the smarter, more entrepreneurial money will be vested in the retail warehouse sector, which is showing far better value for money on pretty much every metric, with the potential for alternative uses underpinning residual values. Additionally, with retailer demand being strong, Nalin will touch on that later, and covenants improving due to impressive post-lockdown trading in most sectors, investors have the confidence to deploy capital here. Another key driver, which can't be understated, has been the government, unwittingly, I suspect. In our opinion, the government guidelines have been instrumental in providing credibility and resilience to the retail warehouse market, specifically by creating the phrase essential retailers. I think we know who these are, but to confirm, these are those retailers who under government guidelines continued to remain open during the lockdown. Food stores, DIY chains, pharmacies, pet stores, bike and motor accessory chains were all held as essential, and so were allowed to be open and trading during lockdown. Only this week, we've seen an investment in Maidenhead let to Homebase Halford's Pets, an agreement for lease with a gym operator, demand for discount food being purchased for a strong price, all being underpinned by what I've just said, but also alternative uses. I would add, one of the most important things is all the rents there have been paid. So the investors perceive this type of asset class as a pandemic proof at the moment. In addition, with essential retailers staying open and others closed, the perfect platform has been provided for those retailers to attract as opposed to attack many new shoppers. And it's clear from the data collated that footfall in retail parks during and post lockdown has suffered far less than covered malls. Shopping habits are habitual. We all know that. So many new customers now venture to retail parks where perhaps pre-pandemic they wouldn't have done so. Coming to the end now, thank you. Another solid foundation has been the continued rebasing of the high rents set pre-Brexit in upward-only leases. With Brexit and the pandemic following concurrently, there have been several corporate failures which have allowed stronger covenants to take the space of previously poor, weaker tenants on longer leases at more affordable rents, which in turn has created a stronger platform for investors. There is one subsector which scares investors and that have less confidence, and that's the fashion sector. We do know fashion in retail parks is now performing better than the high street, but I suspect we will not know the true extent of the damage caused by the pandemic yet. However, we can take some positives away from the fact that the latest ASOS numbers are not quite as good as many as expected. And so it may be that shopping habits haven't reverted to type pre-pandemic, as opposed to losing out to those online platforms. But I think there's a lot of work to go in that. Anyway, that's me. Let's see. It's all to play for in exciting times. Thanks, Andrew.
Thanks very much, Jonathan. I think you make some really fascinating points there. And I think, like you say, the bounce back in the ONS figures of the share of physical sales versus online shares has been pretty marked, I think, since the reopening of physical retail. And as these numbers show, I think retail parks are driving a lot of that interaction with consumers. So some very positive aspects going forward. I'm now going to hand over to Nalin, who's going to talk through the latest occupier activity that he's seeing from his work across the market.
Thanks, Andrew. I think quite a powerful statistic is that at Harvey Spack Field, we advise on around 50 million square feet on behalf of landlords, and the volume of leasing transactions tends to follow a fairly consistent pattern on an annual basis. In the last 12 months, we've seen the volume of leasing transactions double from what we normally expect to have seen based on previous years. And I think the main driver for that, when everything is stripped away, is a combination of the fact that you've got a positive trading environment and you've got retailers locating on parks where rents exist at levels which make it more affordable for the occupiers to take space. And going back to that earlier point about trade being strong, I mean, that is always going to give occupiers the confidence to do. And in terms of what they've been doing, there's been a lot of store rationalization where occupiers are looking at their portfolios, looking to re-gear and commit long-term in locations where they can then extract some incentive from the landlord to reinvest in the store, to create a refresh. There's been occupiers looking at new formats to take advantage of changes in consumer demand. And then there's been the standard tried and tested occupiers just looking at expanding into locations where they're not represented. And again, it all comes back to the fact that there is more confidence from them when they're looking out and seeing what the trading numbers are doing. I'd say also that there's less, I suppose, drive from PE-driven models at the moment. The need for occupiers necessarily float. I'm not saying that those factors aren't in existence, but I just think they exist to a lesser extent. And the positive thing for the sector is that the high number of transactions has really been driven by how well occupiers are trading. I think it's important to refresh ourselves as to what the subsectors are within the retail parks market and what they've been doing. And if you look at the food sector, the main drivers of growth within that sector are Aldi and Lidl. Now, if you assume they're looking at taking circa 50 stores a year, let's say 30 of those are on retail parks, average store size is 20,000 square feet. That's 600,000 square feet to each occupier of new space in the last 12 months. So it combined 1.2 million in parks. M&S Simply Food are powering ahead with their new format, which is for larger food stores. And the food warehouse is still moving ahead as they have been. That doesn't include the likes of Morrison's, who we know are looking at smaller formats to try and challenge some of those names on retail parks. Value non-food, still very much driven by the likes of B&M, Home Bargains, and The Range. Again, looking at very crude numbers, if B&M and Home Bargains both take 20 stores on retail parks in the last year, which is not an unreasonable assumption, at least. The average store size is 30,000 square feet. That's between them alone 1.2 million of new floor space that they themselves would have taken. If you throw in the numbers that The Range would have taken as well, that pushes that figure way beyond 1.5 million. I think also interesting within that space is that Poundland have come forward in the last few months with a new store format, which is where traditionally they were looking at more 10,000 square foot units. They're also looking at now larger stores of 20 to 30,000 square foot plus. And they're really challenging the main names in that sector now in terms of the race for space that we're seeing. DIY remains very strong with the main names of B&Q, Homebase and Wix. We know that B&Q have been looking at more store rationalisation through Project Bloom, where they've been looking at re-gears and reinvestment, which is the same as Homebase as well, who have undertaken a number of re-gears, but are also looking to expand the portfolio and have taken 5 new stores in the last 12 months, with more planned over the coming years. The bulky sector, I think I touched on this last time, where the bulky sector in some ways benefited from COVID because it accelerated the restructures that were sort of hanging over the market, and I would say restricting to an extent landlords from being able to asset manage those schemes effectively. It's always difficult to plan when you're not quite sure of the ground ahead of you. But those restructures to the likes of Home Style through Harvey's and Benson's, Oak Furniture Land has given the market firm footing, and has also created more available space, which in the main has been taken up to a significant extent. And certainly in the stronger locations, we're seeing deals being done at levels which are not too far off where they have been. I would say across the bulky market, it's fair to say that most, if not all, of the occupiers are looking to expand, some more selectively than others, but it is really positive for that sector that the weight of requirements now is pretty high. Moving on to Open A1 and fashion, I think as Jonathan mentioned, is certainly perhaps the subsector which has received more negative press than the others. But we are seeing plenty of examples of green shoots. We've got a number of situations where there's an occupier that has a retail park presence and a town centre presence. And because the town centre has become more unstable, with say the closure of a John Lewis or a Debenhams, we're seeing that occupier close their town centre store and look to consolidate on the retail park for the longer term and then reinvest further in that store. New Look is an example of an occupier who has perhaps lost more stores than they have expected to from the CVA, and are now looking at re-gearing on a number of parks to try and consolidate the estate and take units out of the CVA. Mountain Warehouse have a new model where they're looking at taking larger units, where traditionally they've been around the 3,000 to 5,000 mark, and they're now looking at 10,000 square foot units. The athleisure sector powers forward with the likes of JD Sports, Sports Direct. You also have the flannels and the larger Frasers concept. And that's also supplemented a little bit by the likes of Adidas, who have acquired selectively. We know that Nike Unite are looking at a new concept and are looking at rebranding their store at Vista in the new format. And around that as well, you've got the likes of Superdrug as well, who are also still expanding at a pace, albeit selectively where they feel the market's right for them. I think beyond that as well, we are seeing some more high street names popping up on the fashion parks. The likes of ProCook, Holland & Barrett, The Works, who again, we've got specific examples where the surrounding town centres and shopping centres are more unstable in terms of their tenant lineups, whereas the fashion park offers a firmer footing for those occupiers in terms of short, medium and long-term offer. And we're seeing those requirements manifesting themselves. Moving on to leisure, the gym market has rebounded very well following the restrictions that were placed upon it through COVID. Pure Gym and the gym is still power ahead with their expansion programs, and there are other gyms around as well looking to join the race. It's certainly our view that parks which offer a leisure element and particularly an experiential leisure element are much better placed at drawing in more footfall, a greater diversity in customer mix. I think there's no greater example of that than Rushton Lakes, which is a slightly unique example because they have a large lake, which is quite unique for a retail and leisure park setting. But I think there's no question in my mind that the retailers there, who all do very well, from what we understand, are helped significantly by the enormous draw that the experiential offer and A3 market there provides for the location. So I think in summary, the subsectors are doing pretty well. Volume of deals is up 100% from what we're seeing at Harvey Spack Field. And I think this probably takes us sort of nicely into the investment piece, I think, Andrew, and for Justin to comment further.
Thanks very much, Nalin. I think, like you say, some real positive indications there around occupier performance that, as we're seeing with that confidence in the sector, is then informing the investor activity as well. Just before I hand over to Justin, I just remind people on the session today that if you do have questions, there is a Q&A box that you can add questions to, and we'll look to answer those at the end of today's session. So now I'll just hand over to Justin, who's going to talk through, from the investment perspective, the last 6 months.
Thanks, Andrew, and good morning, everybody. So I'm going to cover the investor and capital markets piece, and what I want to try and cover is a bit of context in terms of what we've seen in the last 18 months. I want to highlight the market's resilience in the face of probably the most challenging headwinds that most of us would have seen in our lifetimes, and explain why we think that the sector has further to go in terms of recovery. So this chart, this shows quarterly volumes for non-food retail warehousing traded through 2020. So Q1, just under 450 million transacted, which is a fairly standard Q1 in the context of the sort of established history. I would say that it followed a building of momentum at the back end of 2019 as we came out of the sort of dregs and the tailwinds of Brexit. And the market was upbeat and it was positive, and we felt we had a good 12 months to get transactions done. Of course, COVID then hit and we came into Q2, the start of lockdown, and the circa 100 million of transactions which are shown on this chart, they were essentially deals which had already exchanged. There were no new deals agreed and transacted in Q2. We're all locked at home, probably not all enjoying, some enjoying this new world, but the market really had no momentum at all, and we will wait to see what was going to happen. Coming into Q3, we saw around 320 million transacted in deals, although the majority of this volume was long let DIY in the form of B&Q stores, I don't actually think there were any multi-let schemes traded in Q3, but even at that stage, we were starting to see some very tiny green shoots come through. We'd all been at home for the best part of 3 months. And then coming into Q4, well, there was 800 million traded, and this was very much the start of the market sitting up and taking a positive look at retail warehousing in the context of lots of other investment sectors. So we finished with about 800 million in Q4. Just to highlight, normally we see around 800 to 1 billion traded in a normalized year. So that's a pretty impressive statistic. Total year volume ended up being about 1.8 billion. And that compares to an established annual volume of around 2 3/4. If you'd said to agents and investors back in June last year that we were going to achieve 1.8 billion in volume, I don't think anyone would have agreed with you. They would have expected it to be significantly lower. So who was behind that activity in 20? Well, no surprise, UK institutions made up about 70% of sales volumes, about 1.3 billion. They're fairly typical, the biggest supplier of stock to the sector being the biggest owners. But conversely, through the course of last year, they only made up 24% of acquisitions, and normally that would be 50, 60, 70%. The biggest investor in the sector was M7, who transacted about 300 million, which was 16% of the market, very much having made a call on retail warehousing. US Realty were in fact the next biggest buyer, acquiring around 180 million of DIY assets, all being queues. In the second half of 20, there were only 3 multi-let retail parks acquired by institutions: Cambridge by Railpen, Crayford by Patrizia, and Oxford Templeton Shopping Park by Hermes. Multi-let retail parks were really not on the horizon for institutions for the vast majority of 2020. Even more surprisingly, and demonstrating how few fish there were in the pond, the 8 biggest investors made up 54% of the market in 20. So everything shrank down. But as I say, the fact is that looking at the numbers, you can point to the bottom of the market having occurred 3 or 4 months within the start of lockdown, and within 6 months we're already seeing these very positive signs of recovery. That's very impressive when you consider that our Prime Minister had COVID, been in and out of hospital. Lockdown 2.0 wasn't even in sight yet, and there was certainly no visibility on an effective and deliverable vaccine. So people were coming back to the sector before we really had a lot to grasp on. So this slide up at the moment just identifies some of the players who were active in 20, and John mentioned some of the names and I've covered off some of the numbers. If we then flick onto the next slide, which is a graph showing again quarterly volumes for 2021. I'm not trying to dazzle you all with too many numbers, but again just very much undermines the positives we were seeing and this sentiment that was coming through. So Q1 just over 500 million. Very positive Q1, however you want to look at it, and in whatever year and context. And again, that was very much seeing the momentum carry through from Q4 in 2020. Q2 at 1.1 billion traded, big 2Q, Q2, but I'm not going to complain about the amount of activity was happening. That's carried through into Q3 again, where we've seen just under 1 billion, about 965 million traded, and then to date. In Q4, we've seen about 470 million traded. There is a further 235-ish offer, and there's at least another 500 million in assets which are on the market and will go to bids. And as John touched on, competitive bidding is fairly established at the moment, so we fully expect all of those parks and assets to trade. So that very much sets out the recovery for the last 18 months. And now I just want to give you the reasons why we think there is still further recovery to come. So supply versus demand. Sorry, not to flick over this slide, which talks about who's come into the sector and been active in 2021, but the names will be recognisable to you all. So supply and demand. We are now a shortage of stock against capital seeking opportunities in the retail warehouse sector. Institutional owners have always dominated the ownership makeup, along with the larger REITs, the likes of BL, Landsec and Hammerson. However, with recent activity, those institutions seem to have achieved their targets and needs when it comes to weighting and portfolio churn. So they are not putting further stock onto the market, or certainly not in any great volumes. And indeed, a number of them are now back in the sector looking to acquire, and I'll come to that in a minute. Ordinarily, we would expect to see significant volumes of sales launched in September and October to catch the end of year heat. But actually, we've only seen around 450 million, which sounds, it's not a small number, but when you consider that 300 of that comprises Castle Point down in Bournemouth and the brewery in Romford, it's actually not leaving much else new to look at. So we've got more cash chasing stock than we've got available to buy. Next point I make is that the average cost of capital seeking to warehouse investment opportunities this year has been gradually reducing since January. So the biggest buyers in 2021 today, Columbia Threadneedle around 450 million, most recently completing the acquisition of Boys, which we did on their behalf. Brookfield's acquisition of Hammerson, the Hammerson portfolio and 2 schemes from Newby means they put about 400 million to the market. US Realty have moved beyond acquiring just B&Qs, but now we'll look at the right multi-let schemes and have placed around 380 million, and M7 have done about 360 million transactions. So they're your top 4. And with the exception of Realty, all of those investors have been using debt and leverage to achieve higher returns. At the moment, UK institutions make up about £600 million worth of transactions, which is just under 20% of the volume this year. And what will drive further yield compression is increased demand from those unlisted institutional buyers. And the figures demonstrate that's been building since January. So Q1, 25% of the market was bought by funds, slightly skewed by the activity of Threadneedle. Q2 was 9.6%. And at that point, only 4 different institutions had acquired multi-let retail parks. By Q3, institutional volume made up 17%, and into Q4, we're just under 50%. Granted, boxes at 150 makes up a big chunk of that. In the second half of the year, there have been 6 different institutional buyers, and indeed there are 3 further names under offer to buy in the sector at the moment. So crudely, you can say that by percentage volume number of mandates, institutional activity has virtually doubled quarter by quarter. And those are just the transacted figures. What's harder to track, but equally as relevant, is the number of requirements so parties who want to invest in the sector but haven't been able to yet. And we're aware of easily over a dozen of those from UK funds and institutions who are after retail park and retail warehouse assets in the sector. The majority are very focused on food, discount and convenience weighted assets. They want rents below £20 a square foot and whilst close to 10 years, of course. But however, as a consequence of the lack of stock I referred to, we're seeing those parameters move. So parties are starting to consider shorter income, more bulky goods exposure, and slightly less convenience income. The next point I make, which is going to continue to drive the market, is this research-driven theses. So we now have enough data for the research teams, and I'm principally talking about those working for these institutional buyers, to put forward a very firm and clear case that retail warehousing should be the place within retail to put your money. Footfall and trading performance clearly has recovered better for retailers out of town than in town. Rental tone is being maintained more consistently, and letting activity is higher out of town than in town. There is going to be further disruption across shopping centres and high streets with loss or repositioning of schemes, and that's going to benefit out of town as well. Data will drive investors to look at retail parks if they need or want retail exposure. I don't have the IPD or MSCI total return forecasts to hand, but I can tell you that industrial and retail warehousing sit at the top of the list in terms of anticipated returns, and that is going to be another clear guide pointing investors into our sector. And following on from that, the last point I make is around sector arbitrage. So if you look at sheds and retail warehousing as the preferred destinations to invest your money, you have to consider how the two are likely to perform next to each other. And at the moment, there is a healthy arbitrage between pricing for retail warehousing and for sheds and distribution space. The shed sector appears to show no signs of slowing down. You're regularly hearing about yields in the threes being paid, and not just for London locations. And therefore, to our mind, there is clearly room for further yield compression across retail warehouse and out-of-town retail assets that will still be discounted to sheds. The last point I make before handing back to Andrew is that our sectors always bounce back quickly from economic downturns. However, the resilience it's displayed despite the combination of Brexit and COVID over the last 36, 48 months surely demonstrates that it's absolutely set and will always play a key and arguably an ever increasing role in physical retailing. I think it's clear that the investor base is taking that very same view. Andrew, I'll hand back to you.
Fantastic. Thank you for that, Justin. I think some really useful insights there into who's been active and the scale of that activation as well. So what we're keen to discuss and open up to the attendees today is thoughts around where next as a sector we're headed. And I think the activity from both the consumer, occupier and investor basis over the sort of last 6 months and that extended 18-month period has been hugely positive. However, we're not naive to the challenges that will be coming. Now, a lot of these challenges are not specific to the retail park sector, but nevertheless, they do present some considerations for retail parks, whether it be occupier or investor centric. And so I think it'd be great to go back to the Harvey Spack Field team and just ask for some of your thoughts on some of these factors that we see coming forward. Now, Jonathan, I know in your piece at the start that you mentioned a couple of the aspects, particularly those that could impact the consumer. What's your take on those and how retail parks as a format are set to fare?
Yeah, thanks, Andrew. I mean, I think, look, obviously the government have been helpful over the last 12, 18 months in allowing retailers to not pay their rates. I mean, it's fair to say that retail parks don't actually need any local authority services anyway. It's all dealt privately. And so there has to be an argument as to why they pay rates anyway. But, you know, we've seen retailers who've been asked to pay their rates back say, no, we're not going to do that. And for good reason, in my opinion, because it's money for everyone else and they get no benefit from it. But clearly the rates coming back in is going to have an unsettling effect on retailers. It's going to add another cost to their business that they haven't had over the last 18 months. But, you know, looking at the numbers, when you look at balance sheets and you look at people's accounts, and you can see there's enough fat in there to take on the rates. They've had an uptick in trade based on what we've just talked about, staying open, being resilient and having a loyalty and getting a following. You know, I was only, someone was only telling me the other day that a certain retailer wouldn't allow them to have a slot for a delivery, home delivery. And as a consequence of that, they've upped shit. They've gone to someone else who we talk about and who we're doing lots of deals with. And they're doing click and collect. Okay. So I know there was a question on the Q&A, which I've stuck into and had a little look at. And it obviously talks about what that click and collect might do. And I think, look, retail warehousing is very simply a format for all. It is click and collect, as well as being physical retail. And retailers, we've been saying this for so long, Andrew, retailers have been really trying to force their customers into their shops for the click and collect. Because we know that when customers do come and click and collect, they invariably go into the shop and purchase another one or two things, right? So there's a triple whammy there. There's more footfall, there's less cost, and there's more sales. So based on that, you know, it sounds like a really good format. I mean, you know, I've got 5 kids for my sins, and I wouldn't even venture traveling into the high street. You know, parking, getting the pram out, in the lift, down there, over there, up. I mean, turn up to a retail park and fill your boot up and go home. You know, And that's what's going on. And it's been doing that, hasn't it, for 30 years since we picked up the strip mall experience from America. And that's where we are. So yeah, I mean, I can see, you know, I've moved on obviously from the point of the problems. Rates are absolutely a problem, a huge problem. Another problem that we're going to have in the short term is the supply chain, Andrew. You and I know that goods coming from China. You know, we've had the pandemic. There's been a slowdown in production across all industry. I mean, go and buy a car now. You know, I mean, they'll fleece you for it. Only I've sold a second-hand car cheaper than what I could have got for it about 6 months ago, Andrew. But you know, the second-hand car market is telling you everything you know about the supply chain.
Yeah.
Things haven't been built. I think the other thing that I think we're getting over, but was a concern during lockdown, was staff. And actually having, you know, retailers and shops or gyms having actually, you know, those that were open or could be open, actually having the physical workforce to actually make the shop happen and work properly. I think with the vaccination program and the good work the government have done, I think we're over that now. And I actually think that some people who probably took furlough or probably pretended they weren't well when they were, and I'm sure there's plenty of those. I think we're all sick and tired of that, and I think everyone does want to get back to work and get on with their lives. So, you know, there are short-term issues, but I think we get over them.
And I think we might send them I'll send them.
I think that's right. I think just picking up on that point on staff, Jonathan, as well, I think less specific to retail parks, but retail in general has always offered quite a compelling job opportunity for the workforce in comparison to, for example, the leisure or the food and beverage industry, due to the flexibility of hours, the allowance of part-time working, the typical more daytime working rather than evenings. So I think although that is a key consideration going forward about staffing levels, I think actually retail in general is better placed than some of the other industries that will be facing some of these challenges. One of the factors that we did discuss and have noted on here is that boost that a number of occupiers saw over the last sort of 12 months in terms of people investing in their homes and DIY, and perhaps fashion has taken a hit in that period. Do we see that kind of fluctuating or changing going forward?
Sorry, Andrew, say that again.
Do you see a fluctuation in what will be popular on the retail park format going forward? The change from maybe a focus on home and maybe more towards fashion?
Nalin, do you want to pick that one up?
Yeah, sure. It's a very basic but potentially accurate thing to say, in that if people aren't going on holiday, they're spending money on their homes. Now, people haven't been going abroad of late. Holidays have been happening, but not to the same extent which they have. You've also got more people working from home, so potentially saving on season tickets, expenditure that they would normally see as an outgoing going to the office. So with that potentially changing as well, there could be a bit of a headwind coming towards the bulky sector in terms of potentially reduced spend. That being said, I mean, the bulky sector is quite wide. There are a number of uses within that, and certainly looking at some of the sub-elements of that, working from home is now part and parcel of the daily life. So, you know, the requirement for people to upgrade and invest in their homes to make sure they've got the right, I suppose, equipment at home, the right setup still remains. I think DIY is something which, you know, we may see trade come off just a little bit, but at the same time, it is to do with people's habits, and there was a growing shift towards a habit of home DIY, and certainly people spending more on their gardens, which we certainly saw from our own experience of acting for home base in terms of the trade they get from their garden centres. So there are some potential issues that could affect the bulky sector. Will it be a shift to fashion? Possibly. It could easily be the case. I mean, with more people wanting to go out and just enjoy an experience now, I mean, I think it's it's human nature that when you've been in for so long, you want to get out. You want to see people. You want to get out and eat out. I think there will be a renewed emphasis on fashion. I think Next today reported some very healthy numbers in terms of this quarter's sales. It was certainly, I think it was up double digit against what it was for this quarter in 2019. Now, admittedly, that was spread across both online and physical stores. And there's obviously a warning from Next about how things can pan out in the future, but I think that line from Lord Wilson is a fairly well trotted out line. Every time he reports quite good figures. But so that does, as an indicator in terms of the statistics, show that our belief is that bulky sector might be receiving a little less spend. At the moment, Next, which is often one of the bellwethers for the market, is showing they've had a very, very strong quarter.
Yeah. And then just opening up to a few of the wider question and answer sessions and some of the questions that have been posed. If I could perhaps kick off with the key one that I think most advisors, consultants are asked is, if it was your money, what would you be spending it on? And particularly, is there any variance in format or region that might influence your answer?
I guess I better pick this one up, Andrew. So yeah, we've had a healthy debate around this in the office. There's a couple of component parts to that question, I suppose. It depends what returns you're looking to make on your money. So what evidence shows is that if you want very, very secure income, you can go and buy decent food stores or long let DIY, and your returns are going to be, in the 4 to 6% bracket, let's just say crudely. You can bolster those returns by looking at the multi-let sector in certain areas, and this is notwithstanding being able to put leverage in place, of course, but you do start to move up the sort of the yield line as you take on size and scale, increase exposure to fashion in some instances at the moment, and actually at the moment still an increased exposure to bulky goods. So where you've got parks with significant discount, convenience and food occupiers, that is seeing the most secure income and therefore commanding the strongest cap rates. So where would you put your money, or where do we think there is opportunity? I am of the view that buying the right bulky goods schemes, at the moment there remains a window where yields are slightly healthier, and you can probably acquire assets, notwithstanding my comment about the lack of stock, but achieve improved returns, but perhaps benefit from the market mispricing or misjudging the risk attached to those assets. I think sentiment historically has always been that bulky goods was quite a credit-based sector, but again, I think you have to look at the resilience of the operators within it, and those that are trading today will have picked up custom from those who haven't survived, of which there have been a handful. So therefore, the future looks pretty bright for them. And as I say, we've had a healthy debate in the office. Nalin is a staunch supporter of the right fashion offer. John will, sing from a very positive hymn sheet around bulky goods, and I think both have their arguments. And I take Nalin's points on fashion as well. I think they've got to be the right occupiers. I think the rents have got to be right, and I think the locations have got to be right. It's the classic fundamentals again. But right now, I would say look at a good bulky goods park. Probably offers an opportunity that might not for that much longer.
Thanks, Justin. And one of the questions we were asked, and it is something that we're increasingly seeing in the mandate of investors buying, is about the underpin, the alternative use, if retail isn't the whole or the lasting solution. What are you seeing in terms of the viability and of some of those alternative uses, and what are the alternative uses that we're seeing?
So there's another question as well which came up about regions and impact of location on pricing and demand, and these two are of course absolutely linked. I think it's it's perhaps less important now, or still I think plays a role and a part in purchase reports and mandates and acquisition justification, if you like. But the ability to be able to point to alternative use to underpin a residual value is something that buyers do like to do. What's going to happen in the Armageddon scenario that all these tenants go bust and we're left with a site with no one trading from? Can it be something else? Obviously, great to have that fallback, that underpin. It does then, of course, become very geographically specific. So, of course, if you're inside the M25 and in London, then you can point to residential, arguably healthcare, distribution. As long as your rents haven't been at 40, 50 quid a foot, then actually marrying up the right rental level and an improvement in yields arguably will give you that underpin. And there have been a couple of schemes traded in the last 24 months, acquired by the likes of a Prologis, for example, where long term we would expect to see those shifted to distribution or shed space. As you come out of inside the M25, London and the southeast, obviously residual values, shed rents, distribution rents start to come down, and actually the number of instances where alternative use does offer a balancing underpin are remarkably few and far between, because more often than not you end up looking at the worst retail scheme in a town, and it's the worst for a reason, i.e. its location, its configuration, and therefore it doesn't function as well to talk about building high-end resi on it, or indeed sheds. So I think it's a nice to have, but the reality is that the people who have bought invested in our sector in the last 24 months have been trying to acquire what they believe are long-term sustainable retail assets. So they've been focused on rents, renting performance, competing supply, and so on. I don't think many people really want to have to go down the alternative use route. It's a lot more expensive than anyone ever anticipates. I think fundamentally they want to buy sustainable, decent retail assets.
Completely agree, yes. And one of the other questions, and I think it's picking up on something we mentioned earlier in the process, was the popularity of retail parks as a format for click and collect, and how we see that as both an opportunity, I suppose, for occupiers going forward. But someone has rightly noted there's quite a degree of exploration by the occupiers at the moment of how they can best leverage the click and collect opportunity. And I wondered if, particularly Nalin, with your work with the occupiers, if you might have a view on that. Certainly from what Pragma had seen is the popularity of click and collect in terms of the occupier profitability is clearly driving that revenue stream into physical stores. But it doesn't quite seem yet that the occupiers have quite got the mix right between what the purpose of the store is, whether it is purely to serve that click and collect or whether it is to provide a physical experience.
Yeah, Andrew, I think you're spot on with that. I think that it's still very much in the explorative stage. Interestingly, on leases, particularly for occupiers taking service units, there often is a clause within the lease that the occupier has the ability to install a click and collect point at a later date into the store. And we have seen certain occupiers trial that. I know John Lewis Home at specific points. I think there are a couple of others that have as well. But there is that, it's always very difficult, isn't it, in terms of balancing up the need to offer a quick, efficient click and collect service, but also wanting to keep that customer coming through the store to then make a kind of halo purchase as well. So I think it is quite a difficult thing for them to marry up. It's certainly on their minds. We've seen some of the food stores like Lidl and Aldi who have really have looked at doing internet shopping delivery through from logistics warehouses, but are now looking to bring it back through store because cost just it's just too prohibitive. How that manifests itself in terms of a store format we haven't yet seen, because the store size has remained fairly unchanged so far. John, I think you've got.
Thanks, Nels. I think that's right. I think, yeah, I saw the question, Andrew. I mean, I think we've got to just, investors and people have just got to stop thinking that these are three separate markets, right? Click and collect is retail is physical, and click and collect requires physical premises. Okay, you can't just click and collect from somewhere, and you're not going to go and click and collect from a shed in the middle of an industrial estate where it's all dark and not lit. So I think the reality, and we understand the costs of delivery are so high, which is why a lot of my clients just don't do it. They charge for it, and they're perceived to be the worst online retailers in the world because they charge for it, because they don't want to lose money doing something, right? And I think, retailers got to be just very careful not to chase the sales to such an extent where they lose money. And it's all about educating the customer. And Nels is absolutely right. We've got to have click and collect on parks. We do know it, and I touched on it earlier, that when a click and collect situation occurs, there is the likelihood that that person, whoever it may be, will actually venture into the store and purchase more. So you're benefiting, aren't you, from the McDonald's hailer, quick. And that's what it's all about. And so I really do see, do click and collect. Number one, if you have a separate location for a click and collect operation, you've got to staff it differently. The additional costs associated with having off-site warehouses just don't make it work. So I fully expect, Andrew, over the years, for the foreseeable future, for click and collect to be absolutely hard and fast part of a retailer's operation on a retail park. And does that mean we need more car parking? Does that mean, who knows? I suspect not, because it's going to be the same customer and it's going to be a quicker turnaround. So these car parks will clear quicker through this click and collect, as opposed to people spending half an hour, 45 minutes shopping. Yeah. But I definitely see it as an absolute game changer and help to the sector.
And I think that plays, as you say, Jonathan, very clearly to the mind of the consumer what the retail park experience offers, and that to a good degree is convenience and efficiency. And click and collect is a key thread within that proposition. Appreciate we're now up against it for time, so I think we'll draw to a close at that point there. I did note there are a few questions that we didn't get to that we will look to respond on, particularly on ESG strategy at the moment with COP26 going forward. And it is something that we've discussed in our preparations for this, and particularly the opportunity for minimizing last mile delivery, the opportunity for electric car charging points, etc. But we'll look to follow up on some of those questions individually following this session. So I'd just like to take this opportunity to thank everyone who's attended today, and also thank the team at Harvey Spack Field for their insight. We would be very happy to speak to anyone with an interest in following up on this. And hopefully what we've presented today is that key collaboration that Pragma in combination with Harvey Spack Field can provide in terms of consumer insight, occupier understanding, investor strategy, and how you can leverage all of those things to your advantage going forward. So thanks very much again for your time, and we look forward to hearing from you.
Thanks.